Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The origin of the move up here in late March was not a key reversal up or an outside day as in Chicago. Rather, it was how the market headed into that maelstrom of support below, stretching from 1024 downwards, that caused prices to halt their decline and gap higher just at once in early April. The market continued its rise up through what was then the recent 50% Fibonacci line at 1146, which at the time was surprising, given how this level had acted as a brick wall overhead back in mid-March. But then prices started to falter at the then recent 61.8% Fibonacci line at 1183, heading back lower. That was until the market reached the lesser Fibonacci line at 1089, since moved higher, and perhaps more importantly ended up being rejected by the nearby rising short-medium moving average, currently at 1154, and created a weekly key reversal up at the start of May. Prices continued their rise until they peaked on Tuesday last week with a very unusual key reversal up. That was also an indecisive spinning top with a very long tail. All this was just short of the February 2008 all-time high at 1395. We've since seen prices fall in what, to be honest, is a fairly clear zone, filling a gap on the way down. The questions now are whether this is a major topping action or a pullback. The answer to this week is the same as last week. It depends. Sorry to be obtuse, but it does. You see, we have a number of supports below that could halt the market, stabilize it, and cause a possible recovery back up. However, at some point, the climb may be so much and so hard that one would have to say the market is done for the moment with the upside, and we are in a new situation. Thus, the pullback levels could be any one of these. They are the lower time, currently 1266, of the January to March bullish shift pitchfork, the recent 50% Fibonacci line at 1187, the short-medium moving average, currently at 1154, the March-based uptrend, currently 1157, and the 50% Fibonacci line for 2022 so far at 1064. On the other hand, should prices fall down to test and perhaps break the area around the medium moving average, and that's currently at 1029, and then the subsequent March low at 993, then I would have to say the bullish incentive has evaporated and we're in a new scenario. So far this week, the first of these supports has been challenged and breached, if not fully broken. The lower time had 3 consecutive closes underneath. Now, normally I'd now look to retire this pitchfork, but I'm minded to delay this action as it seems there is a parallel uptrend currently at 1210, generated since late April, that is taking the place of the lower time, and it may well be that I should have finessed the lower time to a lower if parallel angle of attack. Hence, I will leave the broken bullish shift pitchfork on the daily chart for one more week at least. I'll now leave you with the same thought I did last week. Please just remember this: between 10:01 and 9:57 we have some very heavy duty supports dating from 2011 and 2012. It is these that are underpinning the current market and its rises, and they will not be easy to dislodge. Minneapolis wheat. Please kindly still ignore the color change in the labeling. It is just my charting system playing its usual silly buggers. There is no special significance in the colors. All right? Okay, so I'm very pleased once more to see that the March 2021 to January 2022 bullish Andrews pitchfork is here, still alive, if just, well, if just, and sort of pointing the bullish direction of this market, unlike some of the others in Chicago and especially Kansas City. The most recent move higher was created from the double bottom formed over March, which, after a lot of hesitation, toing, and throwing of action, and in one case going to the 5th countering degree, saw prices move higher. The market initially ran along the top of the middle time, currently at 1211, of the bullish Andrews pitchfork, but at the start of May, the market made a weekly key reversal up that set prices moving higher at a sharper pace, allowing the construction of a more sharper February to March bullish shift pitchfork, where we can see the market ran up for the most part between the lower time, currently at 12.27, and the middle time, currently 13.41. Now this worked until 2 weeks ago when prices broke up through the previous March high at 12.12. That subsequently set off a rocket under this market. Prices broke up through the middle tine of the sharper angled bullish shift pitchfork. They gapped up over the upper tine of the shallower bullish Andrews pitchfork, currently at 13.62, and finally peaked just short of the upper tine of the bullish shift pitchfork, currently at 14.54, with an indecisive doji cross on Tuesday 2 weeks ago. Since then, prices have fallen. The questions are, much as we have seen in the other grain markets, is this a pullback? And if it is, when does it turn into a bearish market? Well, the answer for the moment is yes, this is a pullback. The market has been in a fairly free zone now until the March high at 12.12, and it will be then that we should start to see supports coming in, such as the lower tine of the bullish shift pitchfork, currently at 12.27, the middle tine of the bullish Andrews pitchfork, currently 12.11, the April 2008 high at 11.66, the short medium moving average, currently 11.74, and the 50% Fibonacci line of the 2022 move at 11.39. That is how I summed the situation up last week. Well, this week we had some indecision at the start of the week, which was actually started from Friday of last week, but which terminated in a final counter to the counter combined key reversal down and bearish engulfing pattern on Tuesday. Wednesday looked at one point like a follow-through lower, but it ended up being an indecisive spinning top that could also be seen as a possible hammer pattern. Now, hammer patterns are usually seen as bullish, which would go some way to explain the moves up yesterday and today. It also does fit in very well with the narrative of two bullish pitchforks still running this market higher, even if they have been under stress. However, one final point: should prices turn and move further lower towards the big congestion area between 1034 and 1083, then we can honestly say the nature of this market is changing away from its current bullish incentive, with a pullback down that may be ending, or at least going sideways, to a more bearish one. Thank you for listening. This short version broadcast gives. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investor Services International Limited. Here comes the final bit.